people see gaps, man. You know, when people see gaps and open, I take advantage of that thing. People see gaps in the Western world. I don't even say it.
Yeah.
It's for real. For real. All right, now let me get the. Okay.
And then Argentina trying to get out there. Everybody trying to go to BRICS. BRICS is hot right now.
All right, cool. Well, look, hey, we're gonna get going. Thank you everybody for coming. Appreciate y'all. We got a great afternoon for y'all. So we got my good friend, business partner, associate, and partner in crime on these seminars and webinars, Jason Matthews of Matthews Financial. And he's gonna come up and talk about what's going on in the economy, what's going on with the inflation as it relates to business. And then what I'm gonna do is I'm gonna talk about some creative ways, creative financing, of how we can structure real estate deals to get done during these high interest rate periods of time when we have inflation. And this is not the first happen, it's the first time maybe it's happened in a long time, but inflation, high rates of inflation is a part of what happens in market cycles. So a big part of that is figuring out ways to make deals happen while the existing market conditions are there. And that doesn't mean that just because the rates are at 7%, 8%, like in the 70s, 18, 19%, that deals can't get done. Doesn't mean that deal can't get done with the bank. And then look, we don't need banks to get deals done. And I'll talk a little bit about that. But let's start with some basic fundamentals as it relates to the economy. So I'll bring my guy up, Jason Matthews.
Thanks, every month, me and my office, we do a recap on what happened last month, usually the previous month in the economy. The reason being is that we go off of data, and most data comes out throughout the month, and we do a recap. So this is the recap of it for what happened in September, but I added some things towards it, because there has been significant news and data has came out this month when it comes to the economy. And the economy affects all of us right now. We see it right now when we go to the gas pump. We see it when we go to the grocery store. We see it in all aspects of our lives, the economy. So everything's about money. So if you guys have any other information or would like to even get this, we're about to come out with another one next week since November 1st is coming up with even more data. This would be a great opportunity for you guys as well. Just email me your guys' information. We're going to definitely put it on our database when this information comes out. Let's look at what happened in September. So in September, I always start off with equities. Everybody knows equities or the stock market, right? So the three major indexes, the S&P 500, which is the 500 biggest publicly owned companies, the Dow Jones Average, which is the 30 biggest company, the NASDAQ, which is the technology companies, they all took a huge hit in the month of September. Actually been a huge hit for this whole 2022. A lot of people have been taking huge hits. And then now the S&P 500 for the month of September dropped 9.34%. The Dow Jones dropped 8.84%. And then the NASDAQ dropped 10.5%, which is very interesting. And I don't think, especially the tech side, I don't think it's over with. If you look at the news today from Microsoft and Google, they're talking about their revenues actually dropped and their sales were down with their estimates that they talked about with their sales revenue, and it just came out earlier today. And then, so when we look at September and October in the stock market, those are usually historically wise where we see the biggest downturns. If you guys were around in 2008, you guys remember the massacre that happened in October 2008. We remember 87 was another major massacre that if you were still around or you was old enough for that period, was usually when we have our biggest downturns in the market. And so in September, it was the biggest downturn we have had in the stock market ever, actually. The S&P 500, because that period of time, has dropped 7% more than 11 times. The Dow Jones has declined 7% or more 13 times, and that's going back to 1928. So what we're seeing is a rare situation. Oftentimes, we see the stock market going up, but right now we have seen the stock market taking a step back, and all this because we are in a new period of time. We are post-COVID. During COVID period, it was the money printing, right? Everybody got a check. We got money from the PPP, the EIDL loan, the unemployment benefits. Everybody was getting so much money. We printed pretty much too much money. And it's not just the United States. The whole world printed too much money. Yeah. So if you look at the Western world right now, we're all going through inflation. Some of us are having it worse than ever, worse than others. Also, you see it right now in Canada. Canada just raised their interest rates due to their inflation version. So just don't think it's an American thing. The question is, how is America going to get out of it? Last month, I was in Huntington Beach. I was there for Pacific Life Environment. They had their head investment person who manages about 90 billion in assets. And what they said, and I asked the question is, everybody's talking about is inflation. And how long do you think we're going to get out of inflation? And the problem, the issue we're having is the feds are saying, hey, we want to raise interest rates and inflation because we have too much money. We want to take back the amount of money that's in inflation. The problem is the government, which is the White House, the Congress, and the Senate, are doing counterproductive things when they really want to. You saw with the most bogus title of a bill ever, the Inflation Reduction Act, which actually printed more money, which actually going to eventually increase inflation even more. We saw it here in California where if you got a stimulus check, you don't want that stimulus check, you try and take money out of circulation right now. So it actually does exactly the opposite of what it would do. So we're actually going through a battle right now on how it's going to happen. Me personally, I think what's going to happen is we're going to prolong inflation a little bit longer. And if you want to study anything, study the 1970s and really start at 68 and look at to 1972 and look what happened at that period of time. Definitely look at this period of time as well when Jimmy Carter took presidency. The Jimmy Carter presidency and Joe Biden presidency are very, very similar on a historical matter. One thing is, as far as presidents-wise, they both were not very popular presidents when they got voted in. The reason why they got voted in was because it was counter of what the other person was before. So with Trump, everybody's like, oh, it's Trump, big personality. We want somebody opposite. With Carter, we was going opposite of Nixon. They both had oil issues. They also have foreign policy issues with the Middle East. And we see that right now where we have major problems and conflicts of our relationship with Saudi Arabia. A huge conflict that we haven't seen with Saudi Arabia in a very long time, which has now continued now into oil production. As now we had a couple weeks ago, OPEC Plus, which is the biggest producer of oil in the world, which is in combination countries, the biggest two countries is Saudi Arabia and Russia. They said they're going to cut oil by 2 million barrels. Back in July, Joe Biden went to Saudi Arabia asking to increase the oil supply so we have more so we have more oil supply and basically supply and demand, the oil price would drop down. But instead, they're cutting back the oil. And now we're using more reserves, which is unprecedented times where we're actually using our reserves to make sure that even if we don't see here in California, gas prices drop, which affects everything, right? How you get your products into the stores, shipping, flying. We all have these issues going on right now with it, right? Also, with inflation, and what we're hearing more about is the word stagflation. So one thing is why we keep seeing the Feds raise interest rates to take money out of circulation, and people saying, hey, the Feds are going to stop or stagger interest rates and go back and drop them down. But one thing they're looking at is unemployment rates. You look at unemployment, we're at full employment right now. If you're looking for a job, you can follow the mirror, there is a job for you. So with that being said, is we need to have layoffs, which the Fed said they wanted to happen. We simply haven't really seen unemployment drop. We're at full capacity. I think they're saying there's 2 jobs in every 1 person right now. Right now, our unemployment rate is at 3.7%. But a survey recently by the S&P, by the Forbes 500 list of company CEOs, saying that 50% of them are talking about they're going to probably lay off next year. Once we start having layoffs, which the Feds wants, because they want to slow down the economy, then that's when we could possibly see interest rates stagnate, stop, or decline. But we're not going to see that stop or decline yet this year. They still have another meeting scheduled in the next week where we're looking at they're going to raise rates even more, 50 to 75 basis points. Let's look at GDP. So everybody says 2 negative quarters is a recession. It's more than that. But if you look at the last 2 quarters, based off those parameters, they've both been negative, but they hasn't been crazy negatives, right? Everybody's working. Everybody's doing good. But 2 negative GDPs means growth domestic product has slowed down. But of course it's going to slow down. Last year, everybody had an extra check coming in. This time last year, everybody got that Joe Biden check, right? Yeah. Everybody's got that 800. So as soon as you take that money out, of course the economy's going to slow down. Yeah. Is that a bad thing? No. We're supposed to go through cycles. Yeah. We're supposed to go through 4 seasons. We just haven't had that. I've been patiently waiting for it to happen. A little bit longer than I thought. I wrote a book about it. Thought it was going to happen in 2020. Then COVID hit. Then we got crazy amount of money, so it delayed a little bit. So let's talk about inflation right now. Inflation right now is at 8.3%, which was August numbers. September numbers came out last week, and it was at 8.2. So here's the thing about inflation. At first, when we had inflation, it was more about products with inflation. But our economy is 2/3 services. So now we went from products down their inflation rate, but services has went up. And so what we're seeing is that it's easy to lower the product, but services inflation rates are going up. And the two biggest things, if you look at the number barometer for inflation that the Feds look, which is core inflation, which is their core inflation rate, which means without food and energy, those numbers are going up. So I don't think we're talking about inflation. Some people will say, I remember August, the president says, inflation is stagnating, starting to flatten out for certain things, but other things, they're going up. Right? Consumer spending is still good, but then let's look at inflation actually in October, which I just mentioned. So the biggest things that we're seeing for inflation, because right now core inflation is at a 40-year high. So we haven't seen inflation like this in 40 years for core inflation. Right now, that means 6.6% growth on those certain things. And a lot of the basic necessities that we have went thing. Everybody knows health insurance. Health insurance premiums have went up 28.2% for the year. Astronomical, right? That's an essential that we all need, right? I remember we always talking about Affordable Care Act and how healthcare is going to be for everybody, but you did control the one thing, which is the cost of healthcare. Rents, right, for primary residents is up 7.3%. Our car insurance went up 10%. Delivery, so everybody was buying on Amazon. Delivery services up 16.4%. And here's the killer for me right now, is airfare. Airfare is up 42.9%. Right? So we're starting seeing the things that still have energy prices are going up. We see things that we really need, health insurance, primary residence. Those things have drastically went up. And the things we don't need as much, such as telephone services, right? Down a little bit, 0.3% for the year over year. Car and truck rentals are down, because remember last year, they increased it because they didn't have enough cars. So you went to Hertz, he was in line at the airport when he was trying to travel and they didn't have cars. But since now they have a little bit more cars, that have went down. And since everybody's money a little bit funny and spending money in more basic necessities, our admissions and sporting events prices have went down as well. But then let's look at food. And this is not included in our core inflation that a lot of us look. Cereal right now is up 16.2% for the year, right? And if you see, and one thing that we're starting to see is shrinkflation, which means they're charging the same price for a box of cereal, but that cereal box is smaller. Or that ice cream, which was a gallon, is even smaller, right? Chicken is up 17.30%. Now it's $9, right? Up 15%. So food price and getting it to the farms, the harder it's going to be to get that fertilizer. So it's going to be more expensive, which is going to come back and make food prices more expensive. So we're going to see food prices for a while go up. The Feds can only do so much with interest rates. Other world where everybody share all their stuff to more of an individual world where everybody just figuring it out for themselves. And the part of the whole process is just want to make things a little bit more or a lot more expensive, right? And then we see it with energy prices as well. So energy prices right now, overall energy CPI, consumer price index, is up almost 20%. Gas up 18%. Natural gas is up 33%. So we're seeing energy prices go up. If you're in Europe, luckily we're not in Europe. If you hear what's happening in Germany, you hear what's happening in England, energy prices are going to go through the roof because most of their energy prices are connected to Russia. Right. And with this war with Russia, Russia said, hey, we're slowing down our oil, our energy towards Germany and the rest of Europe because Europe is trying to go green. They want to try to go green too fast, and they have their own supplies for the energy. So they're saying it's going to be the coldest Germany ever because the energy price is going up so much. So we're going to see, but Europe, our fellow Europeans, our alliance, our strongest alliance, are definitely going to see even worse. That's why you see what's happening in Britain. In the last less than a year, they got rid of 3 prime ministers. Yeah. They got rid of Boris Johnson. They got rid of somebody who's only there for 2 days, and they got somebody else just yesterday. And because of the economy, inflation was going on, and how you combat it. Because what the government wants to do is they want to make all of us feel good, because they want to get reelected. The Fed's not caring about if we feel good. They're trying to do what's best overall for the long-term effects of the economy. And oftentimes, those are higher interest rates hurts everything. And I remember when Trump was president, he used to talk about the head of the Federal Reserve, Jerome Powell, always the most powerful man on the planet. But if you look at it, every president talked badly about any Federal Reserve president whenever they talk about printing money, because it is horrible for you. In 4 years, if we're still talking about inflation, you're going to probably see Joe Biden not get reelected. In November, how it looks like right now, it's going to look like it's going to switch from being a house that's blue and a city that's blue and probably switch over to being red, because nobody wants to be in a place where the economy is not as strong, where they're paying more for stuff, and they're not living the good life like they normally was. So, all these prices are going up. All these prices are going up. So how are people paying for it? If you look at jobs, job pay is not going up as much. So what are people doing? They're borrowing money. Consumer debt is super high. And this is where opportunities come in, right? So Steve going to talk about real estate, right? And talking about opportunities. The opportunities going to be in because some people have over-leveraged themselves drastically. So during COVID, people were saving some of their stimulus money. They spent all that money, and they bought a little bit too much stuff because interest rates were low. Now, as interest rates going up, costs more to service that debt. Now, people are now having more consumer debt than they ever have. Now, as things get tight and we might start seeing layoffs, what's going to happen? I need to sell my car. I need to look at my house. So there are going to be deals for the people who are prudent, who's good with their finances, who's smart, and don't think the world is falling, but people who have their eyes open, looking for opportunities. And so, last month, the Fed raised interest rates 75 basis points. Next month, we're hearing that they're going to raise it next week. It's going to be another 50 to 75 basis points. Some people think it might be 100. What's wrong with that? What's wrong with raising interest rates? It depends on who you are, right? Yeah. So, for instance, why I say that? If you're a retiree, it's a good thing. If you're a pension fund, it's a good thing. If you're an insurance company, it's a good thing. Here's the reason why. Pension funds, insurance companies have to keep the promises that they keep. And part of the promise that they keep is the last 12 years, we've been in a 0% interest rate environment. So they need to generate a certain amount of income for their retirees through the pensions or insurance companies. And because interest rates are so low, they have to take on so much risk to guarantee the promises that they keep. Now that interest rates have went up, it's going to allow them now, with them purchasing new bonds and have saved money, not to take on so much risk, to keep their promises. If low interest rates stayed around forever, we could have possibly seen pensions fold whenever they make a bad deal. We could possibly see insurance companies fold. Matter of fact, we just saw what happened in Britain last month, where they're talking about their pension fund was about to explode. So, but they got bailed out. So it's actually good that interest rates do well for certain people. Some in one culture say there's nothing good, there's nothing bad. It is what it is. So that's how we have to look at it. But get ready for more interest rates next month, right? So the mortgages now are up. We haven't seen that in 40 years, right? 20 years now. 6.94 is the average rate according to Freddie Mac. But I'm hearing some people get over 7%. Yeah. Interest rates have went up. Nature of the beast. But guess what? Costs more to service debt. If I'm a lender, I can give you my money I already have stacked. Now I'm getting 7% fixed. Good money, right? On that. So interest rates are going to go up. Now I'm hearing people talk about, and I had this conversation with somebody last week when we was at the conference for realtors last week, that some people think that rates are going to go back down. My question is how, right? How are rates going to go down in the first or second quarter next year? If energy prices going up, food prices go up, and they're the highest in 40 years, how are they going to lower rates? The worst thing you could do is you have to control inflation.
Yeah.
If you don't control inflation, anarchy happens. People say, what do you mean? If you look at any time in the last 100 years when the economy got crazy, you saw a couple things. One, during World War I, we got Hitler because inflation got too crazy, and that's how they put Hitler in, and that's how World War II got started. If you guys have any questions, please let me know. But like I said, if you guys want my monthly report, let me know. Do anybody have any questions?
I got a question. Okay, a couple quick questions. First of all, thank you for busting that down the way you did, man, because it's really good. But you were talking about some of the inflation numbers. When you said food prices are not a part of the core inflation, or they are part of it?
So they're not part of the core inflation numbers. Because inflation, so you have your inflation numbers.
Yeah.
So core inflation does include two things, which is energy and food prices.
Yeah.
Those are separate.
Got it.
That's the reason because there's more volatility usually in those compared to other things.
So then, wow, but I mean, that's like a core consumer. I mean, we don't live without food. That's what's kind of, so also you're saying, so therefore, if we send the consumer price index rate, that is not including food prices.
Correct. Or energy prices.
That's insane.
Because think about gas and food is so volatile.
Yeah.
So that's the reason why.
So the CPI is only a fraction of what the real inflation that we dealing with. Right?
Exactly.
Okay, I didn't know that. I thought food was a part of it.
No.
That's my. I wish I would have invested in chicken 2 years ago. Chicken prices.
Well, it's crazy. Last year we had a chicken shortage, right?
Right, man. You can get wings on the grill. You can get wings at the stove, man. I remember on 4th of July. It was crazy.
Which makes no sense of lack of wings, right?
Right.
Because you got enough thighs. You got enough thighs. You got enough thighs. We got enough wings. Which.
But yeah, it's crazy, man.
Do anybody else have any other questions regarding?
Well, give a round of applause for Jason Matthews, man. Appreciate it. Okay, we're gonna take like 2 or 3 minutes. I'm gonna bring up the creative financing proposal. Listen, we got wine, we got some snacks. Please make sure y'all meet each other because a big part of these meetings is networking. So let me give my presentation up and we'll talk about creative financing and we'll get rolling. Take 5 though, get you some wine.
Hey, it's 5 o'clock somewhere in the world.
No, so that's crazy. So then if they were to include food, so we're talking like 20%.
There's a website called Shadow Stats.
Or 15, because I mean most of those things were above 15%, right? I mean, right?
Yeah. So there's something called Shadow Stats. This is a website, and it bases inflation off the 80s numbers on things, right?
Yeah.
So if you go with Shadow Stats, I think they got probably like 18% inflation rate. If you base off the 1980 standard. Yeah, but one of the good things also is Social Security. I thought I added it, but forgot to. I seen it up. And Social Security just went up 8.7%, which we haven't seen since 1981 for an increase. So if you was getting a $1,000 check from Social Security, your check just went up 8.7%. First time we've seen it since 1981.
Wow, man.
Steve, you're an amazing host because you don't have anything to.
Good job, Steve.
Hold on one second. All right, scoop to the fruit top. We got something.
Thank you. You were so close. What about behind you? What are those? Just knives? The pink things? Or, okay, this is Cooper. Okay, this is Cooper.
Yeah, actually.
Thank you.
What's going on with you, man? How you been, man?
What's good, brother? What's good? How you doing?
You doing good, man?
Alright, man, I came in at the end of CPI, man. Sounded like we're gonna go up some more.
A little bit. Especially as oil prices go back up again,
Yeah, this is
which we'll see probably in the next couple months.
Thank you.
energy is gonna keep going up. But it's not even winter yet. I mean, it's winter now.
Yeah, but what your issue is your international relations with the OPEC is the issue.
I ain't even worried.
So you haven't seen the oil prices come down. We're using oil reserves with that, which is crazy.
We're only selling it down. Somebody said it's because the dollar ain't working out. That's why we're giving it. It's harder to pay bribes than the dollar.
No, the dollar's value went up because we're raising rates.
It's making everything.
But I should say this. We are the cleanest shirt in the dirty clothes hamper though.
Basically, right?
Yeah, if you look at the rest of the Western world, we're the cleanest shirt in the world. China's struggling themselves. So we are the cleanest shirt in the dirty clothes hamper.
They're struggling with their real estate right now too. And like, you know, like you brought up shadow stats, they always take things in and out of the CPI.
Yeah.
And
So-
like the GDP, they take things.
Yeah, so right now it's like 16.3%. If you look at the stats from how they include inflation in the 80s, it's like 16.3%.
I know two New York strips in the grocery store like $60. I'm like, ooh, this and canned goods. You talking about investing in chicken? Canned goods. I don't know unless I bought a can of Campbell's soup or something like that. Canned goods are like $4 a piece.
Wow.
That used to be like $2-4, man.
And this thing is almost $4 or $5 a piece. Oh, what? Because
Well-
you need oil to produce food.
There's only one thing where prices went down.
Cannabis.
Cannabis.
Hey, thank God for that. We got one. We got one. So look, y'all, well, first of all, thank y'all all for coming. I know we are doing these seminars at 1 o'clock. I can put a strain. I know Ms. Tasha came all the way from the Central Valley, so I appreciate you making that drive. And I know, everybody that's here is busy and has a lot to do. So I'm really thankful that y'all came because I wanted to make sure that we did this market update, to go over what Jason was talking about. Oh, Jay, can you move a little bit that way? There you go. Make sure we got it on YouTube Live and we got it on film, so it'll be on YouTube as well. But I wanted to make sure that everybody in here, for the most part, a few people I don't know, we are involved in real estate in some way, right? And so inflation directly impacts us in a variety of ways. What Jason was just talking about is the economic impact, right? He talked a little bit about the impact on real estate, right? And the biggest impact that we have on real estate is the cost of the money. It's the cost of cost of interest, right? And we, what you said, 6.97%, whatever it is, the average rate. That, for us, in the last 10 years, is a high rate. However, come on in. However, when we look at history, historical, over the last 50, 100 years, it's not outrageous. In fact, my big mama, my grandmother, bought her house, and it was at 19% interest rate. All right, and she was just a little old cook working at Dixon's Fish Fry over there off 90th and East 14th, and supporting a multitude of kids, right? But she was able to make 19%. You know what I mean? Things are all relative, right? We don't want to duck and dodge around the fact that, hey, yeah, this is a serious impact on our market and what's going on. But what I want to do today is give you some ideas and some thought processes maybe that can help you to navigate through these waters. What Jason said was very poignant in the fact that, hey, look, the Fed is going to fight inflation first. They don't mind the recession. They don't mind a down real estate market, right? What they mind and what we should all mind is the brutal impact that inflation can have on the economy. And he gave some examples of that, right? And so better for us to have a real estate down market, better for us to have a down stock market, better for us to have a recession than to have outrageous inflation when you go to the store and it costs you $25 for a gallon of milk, right? Because then that makes it hard for us to eat and to live. That's why I asked that question about food. How can they not have food as a part of core inflation? And it's probably because the numbers gonna look too bad, right? And that's probably a political move, but we all need food. One of my mentor, Paul Chambers, who owns this complex, he always talks about 3 things that are important in life and in business: food, water, shelter, right? Everything kind of revolves around those things right there. Food, water, and shelter, and then, our needs surrounding those. So we have to make sure that we have those things intact that we can eat. That might mean we're gonna have some temporary pain, right? Now, with high interest rates being what they are, all right, it's making getting a loan from the bank a little bit difficult. But did y'all know that in the real estate business, we don't have to always go through the bank? All right, when I got into this business, what got me into this business was a course called the Carlton Sheets No Money Down Real Estate Course, right? And it piqued my interest because it said no money down. And I didn't have no money to put down, so that was perfect for me. But what I learned in that course was the intricate details of this topic called creative finance. So that's what we're going to talk about today. And before I get into it, just a little bit about myself. I started this company, Infinity Investments. This is our office now. We started in November 2009. Anybody remember how the economy was in November 2009? You know, it was all bad. It was way worse than it is now. You know what I mean? But it was actually a great time to start a company. It was tough. It wasn't easy. But it was a great time because real estate was on sale. It was like, you know, it was like Black Friday at Macy's or something. You know what I'm saying? Except for it wasn't all those people rushing in trying to tackle each other to buy some stuff. It was people didn't want to touch real estate deals with 10-foot pole. I remember I was showing people 4 plexes in West Oakland for $125,000. People was like, "Ooh, I don't know about West Oakland." $125,000. Okay, and I had to beg people to buy these properties. I had a client of mine who was wise, but he bought an 81 unit REO, real estate owned by the bank, that I sold him in May 2009. And he bought that for $3.7 million. But I had pitched that deal to at least 50 to 60 people. Because I was pitching hard. And I heard everything. I mean, he bought that property he had previously traded for $8 million. He bought it for less than half of what it traded for. A year later, he refinanced, and it's still down market for $4 million. So he got all his money back, tax free. All right, so there's creative ways to do business in down market. So that's kind of when I got going. That's how I got started. And what's helped me out though is I've also developed some skills, and I think that's what we're doing here today. So hopefully you leave up out of here with something, an idea, a contact, a resource, something that you've learned that you can add to your toolbox. And so for me, a big part of that is serving the people that I work with. I'm big into networking and networking group. That's why I'm saying make sure y'all meet each other, because I've had the honor to be the president of the Associated Real Property Brokers, which is the Oakland chapter of NAREB. NAREB is the National Association of Real Estate Brokers, the Black Brokers Association. I've also had the honor of being president of the state board. So we just came back from our state conference down in LA. It was an amazing conference, really, really great content, great networking. And we get together on a regular basis to share ideas, to share content, to network, to do business, to do deals. I came back from the conference and I'm getting an offer on one of my fourplexes because one of the brothers that was sitting there listening to me talk said, "Hey, you know, I got a client for a fourplex and that won't work." So you have to network. Now, what I would say to y'all is to take it a step further, is to real estate, commercial and investment property. So I have done that. I got what's called a CCIM designation, commercial investment member, but I've also won a designation that I honor as president on that board, the first black president of that board. So I say all that to say, is I learned some stuff, right? I met some people, and I want to translate that to you guys. And today's topic, we're going to be talking about creative finance, all right? Now, creative financing has a lot of different, you know, avenues that you can go. When I say creative financing, essentially what I'm meaning, what I'm saying, is ways of financing the deal outside of the traditional in commercial real estate, 30-35% down, 65 to 70% loan to value loan, and we just close the deal like that. That's a traditional, and now in residential, the rates would be different, but in commercial, we put more money down, all right? So when we're saying creative, we're talking about any way to finance that deal outside of you personally putting 30-35% down, 40% in some spots, and going out and getting a mortgage that's just gonna close that way. There's a variety of ways to which we can get that done, all right? And there's a bunch of different strategies that I'll go over. One thing that I wanted to say here is the pandemic affected the economy in a lot of different ways. You know what I mean? He just talked about it. They had to create all that money because if they didn't, we was asked out. All right? It wouldn't have been a good situation because when they stopped, everybody stay home, big corporate 24-hour fitness wouldn't have been, they didn't have more than a month's worth of operation capital in the bank. One of the biggest corporations in the country. You know what I mean? So what do you think individual families? You know, we wasn't, you know, as prepared like that. So they had to put all this capital in. So they had some effects, right? Now, like what we're saying, now there's high interest rates. Now, you know, banks are, hey, we'll give you a loan, 7.5%. However, there's something to think about in this marketplace. A lot of sellers have equity in their properties. A lot of sellers have equity in their properties. And now, so last year, it was tough to do creative financing deals because someone put a property in the market, 10, 20 offers, get 100 grand, 200 grand over the asking. You know what I mean? Different story today. But somebody got equity. So, man, what can we do, right? So essentially, creative financing is a way that we can get a deal done, either out of bank totally, or outside of the traditional way where the bank just wants you to put 35% down, okay? Now, I'm gonna break down, how many ways that we can do that, but essentially it involves using OPM, other people's money, right? And it could be the money coming from the seller, right? And then in terms of them maybe carrying a first deed of trust, second deed of trust, wraparound mortgage, land contract, a master lease with option to buy, I'll talk about that. It can also come from investors, people that invest with you on the deal. So maybe you find a great deal, you don't have all the cash to close it out, but you want a great deal, I can structure it. Maybe you have some people that you know or can approach some people that you know that want to invest with you, right? And that's not the traditional way. Hey, I got my money, I put my money down, we finance it, right? However, syndications is what it's called. People coming together as a group and buying and investing in property is actually how most commercial companies in commercial real estate go about acquiring properties, as groups, as funds. That's typically how it's done. But for us as individuals, that's not typical. But we can play the game on their level as well. So that's what I want to kind of break down and get into some specific strategies. But you have to understand, like, what is it that we're trying to get accomplished? Everybody don't have 30, 35% down to put down on a property, right? But it doesn't mean you can't structure that deal. Hey, the bank may be giving you a loan at 7%, 8%, and maybe that messes up the economics of the deal. But what about, could the seller carry it? Could they carry it at 6%? And now all of a sudden that same deal that was, I'm gonna walk away because the bank's gonna say 7 or 8%, maybe we can make that happen at 5 or 6% if we can entice the seller to carry at that rate, right? And I know a lot of people with deals that are, on the fences right now, to where it may close, it may not close. If we're able to structure some creative finance, it might be the bridge we need to close that deal out. And for agents that's out there, the thing that a lot of agents don't understand is you can actually get paid by structuring these deals. A lot of people think, hey, seller financing, I'm not getting no money, I'm not telling my clients nothing about that, I don't want to hear about that, I don't want to have nothing to do with that. But I know, like, for instance, Isaac, y'all just executed a lease with option to buy on your property. You know what I mean? And that, as a seller or as a property owner, that actually, when we sat down and we talked about it and we went over the numbers, hey, this is actually a better scenario for you than if you just try to go and sell a property on the market right now today. You know what I mean? You actually come out money ahead, taxes deferred, and better cash flow, which is what your goal was on the deal in the first place, by doing that strategy. All right, so that's, we got to talk about, like, the psychology of what we're doing, right? The benefits of the parties. Obviously, if you're trying to buy the property, if you can get the seller to carry, you get some investors to come on, that's great for you. But what are some of the benefits of these elements of financing for the people who are selling it? And that's kind of what I wanted to kind of tailor this presentation or talk to, is the people who have the properties, who are trying to move them. You know what I mean? For us as buyers, we need to know this stuff, but we really need to be able to articulate it to the end seller so that they understand the benefit and the reason as to why they might want to go ahead and carry some financing. So here's just a few of the reasons. You know what I mean? For us, obviously you can acquire property with low or no money down. You know, you can purchase larger properties that you wouldn't be able to do by yourself, right? You can also, and this is the thing, you can, well, I'll come back to credit, but you can significantly increase your rate of return by putting less down, having a seller to carry. The sellers can actually also increase the return on their equity by carrying in a strategic way, especially if they simply were just going to cash out. Now, if they're going to exchange and they know exactly what they're going to buy, it's different. But most sellers don't know what they're going to buy. Most sellers are not thinking about an exchange. You know what I mean? They might be, but I got to tell you, I talk to these people all the time. I just talked to a guy yesterday, and he was like, well, I'm not going to sell my property at 1.2, but at 1.5, I will sell it because it's enough money for me to, I don't have to pay capital gains taxes. And I was like, explain that, break that down. And his reasoning was, flawed. He was going to have to pay capital gains taxes. He just wants a certain high amount. And I asked him, well, what are you gonna do with that? Yeah, well, no, I'm not doing exchange. I don't wanna do exchange. I said, that's why I don't wanna do it. I said, well, okay, you gonna pay the capital gains taxes. The more price you get, actually more capital gains you're gonna pay, right? And we went through it, and I said, well, how much you think you might have to pay on the capital gains? Oh, man, I'm not, if I sell higher, I'm not gonna have to pay. What I told him to do, make sure you talk to a CPA, I'm not a CPA, but that you're probably looking at about 30 to 40% in taxes. You know what I mean? And when he's hearing that, oh, well, I'm not selling it, I'm not. But his whole goal of me having a conversation with him, because he wants to get his money out of the property, or he wants to get a better cash flow, right? He's not happy with the cash flow he has now, he wants to move on. But he wants a price that's not realistic today, and he's misconstrued about the taxes he's gonna have to pay. So what I simply said to him, have you considered financing? That wasn't even something he thought about, right? And we're gonna follow up with him and talk to him about it, because I was saying, hey, you can get a better return, cash flow, right, from your equity, right, than you're getting right now, and you don't have to do the work, and you're not gonna be paying the taxes immediately when you carry that paper. So for him, the seller, now he, on that transaction, is gonna make more money than he's making now in a tax advantaged way. For us, if we're structuring that deal, as a buyer investor, we put less money down, we hopefully negotiate interest or payments that are better than the marketplace, or at least lower than the overall rate of return on the property, so that we take our return, we take the property's return and we expand that by utilizing financing from him at a lower rate than what the property generates. And what he can then do is get his equity more productive in a more tax advantaged way, you know? So that's critical to be able to make a deal work when we're in this 7% interest rate environment. Another thing to think about, if you're trying to get somebody to carry financing, you may not qualify for the bank, even if it's 7 or 8%, whatever. You know, now commercial loans, you got a good credit, but then they're also gonna look at your balance sheet. How much equity you have, what's your net worth, right? So a lot of banks wanna see you have somewhere close to either 50% or more. If you're getting a $3 million loan, they want you to see you at least worth $1.5 million, if not close to $3 million in commercial real estate. They want to see, residential is different, but they want to see you have some net worth. So say you ain't got that, right? If you go with the seller, you can negotiate. They're not probably running their credit. They're probably not asking for a balance sheet, and even if they do, you can talk to the person. You know what I mean? So these are great ways for us to structure deals. Very good deals there, right? Well, the biggest, and chime in on this. We got a small group, so chime in on this. What are some of the biggest, in today's scenario, what are some of the biggest challenges to the marketplace? We know the interest rates are high, right? But anybody out there have a, like say, listing, or you're working on a deal, and you're trying to, there's maybe a buyer and there's a seller ready to go. What are some of the biggest challenges that y'all seeing out in the marketplace right now between seller and buyer?
Kind of weird to say with pricing, I would say. Pricing is still very high.
I would say that's the number one thing. The seller, I heard this at a panel the other day. I said sellers want the yesterday price. They ain't getting that today. You know what I mean? And sellers have reasons for the price. Some people have legitimate reasons. And they say, if I don't sell that, if I don't get this price, I'm not going to sell. Right? And I was just talking to my boy who was moving to LA. He's thinking about selling his house. And he was saying, man, if I know it's down. If I don't get this price, and I'm thinking, man, it doesn't maybe make sense for me to sell, right? And there's formulas for that. For everybody's different. For investors, it may have a specific. They may have a specific rate of return they're trying to do. They may have something that they're trying to accomplish. They have a point to where it don't make sense for them to sell, right? But for by and large, most people, they haven't thought through that. What could help them get their price is if they were to carry financing. You know, it's a cash buyer. Would y'all agree? A cash buyer generally is going to probably pay less than somebody coming along with financing, right?
Yep.
So if I'm a seller, I'm willing to take that cash price because I know it's gonna close in 2 weeks. I ain't gotta worry about no bank, I ain't gotta worry about no appraisals, all that stuff, right? Bank, if somebody comes with a bank appraisal, I know, hey, look, I gotta get a little bit more on my price because I gotta go through the appraisal process, the bank process, so on and so forth. Boom, there we go. If I'm willing to finance the transaction as the seller, well, I'm not gonna get all my cash up front, but maybe I can ask for a premium on the price because I'm gonna get my cash over a period of time. And what typically happens on seller finance deals, it's very rare that you'll get a seller finance deal at a cash price. When you're negotiating seller financing, a lot of times what you gotta do is be willing to pay them their price or give them their price. And the strategy on that is your price, my terms. So you want $1 million, even though maybe it's only worth $9,950, okay, we'll give you $1 million, but I want you to carry this at 4%. You see the power of that? Because don't the interest rates influence the prices anyway? At the end of the day, if there's 2% money, so if we can come and say, hey, as a seller, why don't we carry this financing, right? And in doing so, maybe that allows you to get your price. Now, you don't get it all today, but over time you can get there. And you can get there with interest, and you can, you don't have to do an exchange right now, you can defer your taxes. So another great thing to think about in terms of the seller's mindset of why they would carry, why would they finance, right? There's another thing that like if the property has some high vacancy, it has some issues, that's what you do. You'd be able to, you gotta get creative with this. Or you drop your price to the rock bottom. And if you don't wanna drop your price to the rock bottom, you can't. So I've talked to you guys about as buyers and investors, we wanna get seller financing, creative financing, I should say. And now as a seller, what are some of the benefits to them to doing creative financing? We were talking tax benefits, getting your price, and then getting a better return on your equity. That guy says, hey, I'm gonna get 1.5, I'm gonna cash out, right? He is gonna have to pay capital gains tax. Say he don't have no mortgage, so say he gets 1.5, now he has a basis, but let's just say 1.5 is his profit. He's paying tax on 1.5, at least 30%. You know what I'm saying? And that's, what is that, 450? That don't make that much sense. That's that ouch in the word. You know what I mean? So those are some of the reasons why you would care. Now, a couple of rules of thumb. I just said this, but I'm going to break this down a little bit more because a lot of times people get over aggressive when the market starts to shift. That's what I saw last time. I saw a lot of people miss out on great deals by over negotiating because a lot of times you have to negotiate for terms, right, and not so much the price. And like I just said, you're not going to get the cash price on a seller finance. You know what I mean? You can't have your cake and eat it too. Unless they, now I did see some crazy stuff happen in 06, you know what I mean? In 06, 08, 09, in terms of I had a client buy a loan on an apartment building, a 61 unit apartment building, and it was like a $4 million loan. He bought it for $400,000. Now that's an anomaly, but he did buy that for $400,000, but it was cash. He didn't come to the bank and say, hey, let me buy your loan. And what that means is when you buy somebody's loan, you become take over their position, and you can do the foreclosure, and you can take over the property. It's called loan-to-own strategy. A lot of people do that. But you can't go to the lender and say, hey, you have a $4 million loan. I'll buy it from you for $400,000, and then I want you to carry the finance. Okay, that's a back. They try to be done with it. You can say you go $400,000 cash. You know what I mean? Now you might have been able to say, hey, I'll buy it from you for $3 million, and you carry it. Something like that. When you're negotiating when you're asking for creative terms, you have to kind of negotiate, give them their price and negotiate. Buyer, you never really want to overpay because at some point you have to sell, refinance, exchange. And so you want to keep that in mind. So you don't want to pay more than the property is worth or what it could be worth. Because you might be getting a property that needs to be renovated. Maybe it's not there today, but you know clearly when you do price setting. Then what you got to do is you got to make sure that the property cash flows. Now, like the property, I'm selling a building right now, West Oakland, and it's a seller financing. Building's vacant though. So day one, it's not going to cash flow. But they're getting it at a pretty good price and a very good terms. We know the market rents, and we know over time in that area, they will be able to get a tenant. When they get one tenant, they're positive cash flow. If they put space down in 2 spots and get 2 tenants, they make a lot of positive cash flow, right? So there's the prospect for positive cash flow, a realistic prospect, not pie in the sky. You know what I mean? So that's a rule of thumb. But that don't change though. Like if you're in it came to any of my other seminars, the main thing I talk about is like a cash flow model. Making sure, analyzing income and expenses, making sure that the property's cash flow. And that don't matter if it's creative financing, syndication, you buying it outright, that has to be a part of what you're thinking about doing. Because you don't want to just buy some property based on, hey, it's gonna go up, I'm gonna make some money. Not worried about the cash flow. You know how many times I heard that last year? We sold, and we sell apartment buildings mainly, but we sold 4 office buildings last year. And I think all of them were all cash, right? One of which the guy asked me when the contracts are listed, I asked him when he wanted to do inspections, the septic inspection. I don't need no inspection. I'm good, we'll close the deal. It's good, we're gonna make much money. If you are gonna make a bunch of money, you still need to inspect the property. If you are buying an asset and you think it's gonna go up in value, excellent. It still needs, the cash flow needs to support the building, right? It needs to support the building. Because if something goes wrong, then you asked out, then you're losing the property, right? Versus that, oh, okay, you know, the market shifted, but we're still able to pay the bills. A lot of people who walked in their properties when the market changed last time, because we're upside down. You know what I mean? Now sometimes you got caught in short-term financing, whatever this is like that. But it was because, hey, we're not able to service the debt that's coming in because we just bought the property knowing that it's going to go up. When it stopped going up, the show's over. So that's a rule of thumb, man. You know what I mean? And the last thing is to make sure all the documents. If you do it, I'm about to blast through real quick and get out of here. That specific strategies, whatever specific strategy you use, you want to make sure the document is recorded in public record. Now, there are documents such as like lease options that it is very difficult to get those recorded. I have worked 2 deals in Oakland where we were able to record the option, but then I've worked this in 3 other counties where they told me Santa Clara County, San Joaquin County, and Contra Costa, where they told us when we tried to go as individuals to the courthouse to record the specific deeds or options particularly, they would not record it. They were saying, hey, we don't record options. You know what I mean? Which is weird. Alameda County, I've had 2 deals where we did get our option recorded, and that was very important, right? So even if you don't have an option recorded, you need to have it properly documented, and I would advise notarized. You know what I mean? Making sure that you got your documents in a row. You know, they can't come back and say, oh, you bamboozled me and carried this finance. No, we sat down, it's notarized. Shit, it's legitimate documentation. Deeds of trust, like I'll talk about, those are easily recorded. County court will record that all day long. But I'm just giving you a heads up. Sometimes options they won't. It kind of varies county to county, right? Now, here's a couple of the techniques that I bust down exactly what they mean. Master lease options. It's the same thing in residential if you heard of lease options. Once you get 2 or more units, though, we call it a master lease option, right? Obviously, because you're leasing more than 1 unit. All right. Land contracts or contracts for deed. These are called installment sales. So a lease option and land contract, they work very, very similar. I'll break down what that means. But both of those methods involve you as the buyer obtaining what's called equitable title. That means rights to the title, right? Equitable title means rights to the title, but it doesn't mean that I own the title outright. So in other words, in these 2 strategies, the deed doesn't transfer at close of escrow, right? There's a period of time, like installment sale, that period of time, option, master lease option, the option period in which you are working towards obtaining the deed, but you don't got to get it, all right? That varies from the next strategy around mortgages where you do get the deed, and I'll explain what that means. Seller carried first or second deeds of trust where you do get the deed, and it's just like what it sounds. The seller carries the first or second position. Joint venture partnerships, crowdfunding, structured finance, syndications are all ways for you to creatively finance. They invest on top of the first loan. So there's typically a senior loan in position for 60 to 70%. and then an investment company called structured finance or mezzanine financing, because it's mezzanine stacked on top of the existing debt. So, you know, what we do on an individual basis is kind of syndications, put a few dollars together and we go buy a property. You buying a 200-unit apartment building, you're gonna use some structured finance if you're doing it that way. Meaning that you got a company coming in, an investment firm, they're gonna probably put up, you know, a couple $1 million in a mezzanine position behind the first. And we can do that individually with individual investors on a smaller level, all right? So those are just a few ways. There's other ways, but these are the most prevalent ways and the way that I know the most about it. I'm gonna break these down to y'all because every single one of these I've done at one point in my career now. Okay, we'll start with seller carry back first deeds of trust. Now this is the easy one. Y'all understand what I say? Is anybody, when I say deeds of trust, everybody got that? All right, first and second. So I'll give you an example of deal we're closing now in West Oakland. The seller's carrying a first position mortgage at $700,000, the deal's $900,000. So the buyer's gonna come in with $200,000 down, seller's gonna carry $700,000 at an interest rate that's better than the marketplace, right? So that's a first position deed of trust. We could have also worked the deal this way. We could have said $900,000, buyer, you go out and get a loan, for, you know, $700,000, and then seller, you carry in second position with $200,000 down payment, right? That could have happened, right? In this situation, the seller carried the first, but the seller can also carry the second. And you know what I mean by second is behind the first, right? As the senior priority, they will only go up to a certain level on the value, right? But you can put a loan behind that, especially if it's a seller. Now, word of caution, some lenders don't like that. You know, they don't like you putting loans behind that, right? Big banks particularly. Hard money lenders, they don't really care, right? So there's ways you gotta finesse this, but a lot of lenders will allow seller carry financing. What they won't allow is 100% seller. So let's say they give a loan for 70%, the seller can carry 20%, they want you to come in with 2%, or I'm sorry, 10%, or maybe 5%, however they end up structuring, right? They want what's called skin in the game. But that's another way that you can structure a deal, especially if you don't have a lot of money down, all right? You can have get a loan in first position, and then have the seller come and carry behind that position, so that minimizes your payment. And when I was talking about increasing your returns, if you only put 5 or 10% down, and the property, so less of a down payment, that should, if the property is positive cash flow, should increase your overall rate of return, because you put less money down, and the property still, if it's still positive cash flow, is generating cash flow, then you're making a spread on the bank's money and or the seller's money. So if the seller carries at 5% and the property is generating 6%, you're making money on their money. You understand what I mean by that? So now that increases your overall rate of return. And that's the big, a big part of why we want seller financing is, okay, less money down. Where that economically benefits us is that expands our rate of return. Make sense? And just like with any other loan, what a company of deed of trust, that must be a promissory note. That is a document that does not get recorded. The deed of trust gets recorded against the property. The note spells out the terms of the loan. All right, that's real. It could be a 1-page note, it could be a 10-page note, but it's a promissory note. Same thing like a bank, but it's through the seller. It's essentially where the seller now becomes the bank. The next strategy, now this is where, how many people heard of, just raise your hand if you've heard of lease option to buy before. You've heard that term, you talked about that. Anybody done any of those? I know, we just did one, you know what I'm saying? And we worked the option on Burwood. It wasn't a lease, but it was an option on Burwood. And I've done several of them before. I've even, as a broker, set them up. And yes, you can get paid. That's the thing that agents and brokers don't understand is you can get paid. Maybe not the full commission, but 100% of something is a whole lot of, a little percent of something is a whole lot of better than 100% of nothing. You know what I mean? And it's a way to serve your clients, which we're supposed to be doing in the first place. All right, that's what we're here to do. All right, now, where it's different than a regular lease option is there's multiple units. That's why it's called a master lease. right? Because you're now, when you do a master lease deal, you're leasing the entire building, not one unit. You know what I'm saying? That's when it has to be clarified. It's a master lease. It's not, I'm not leasing unit A in the 6-unit apartment building. I'm leasing the whole building, right? Here's what that means. It's when you essentially take over the operations. You say to the Mr. or Mr. Seller, I'm gonna pay you $5,000 a month for your building. So I lease your building, I pay you $5,000 a month. I'm gonna collect the rents, I'm gonna pay the bills, and hopefully there's something left over for me, right? As it should be, or else why would you do it? There should be something left over for you. Now, that's the lease, the master lease scenario. What we couple with that is an option agreement, right? Which is actually like what we did. We had a lease agreement and we had a separate option agreement. You know what I mean? The option agreement, and you have to pay a fee for this. We call it option consideration. It could be $1, it could be $100, it could be $10,000, it could be $100,000, whatever. I generally like to keep as low as you can go, but 1 to 5%. You really don't want to spend more than 5% of a property in terms of option fee. Here's why: it's not refundable, right? So if you an option is time sensitive, so it can be 1 year, 2 years, 6 months, whatever y'all negotiate on. But you got that period of time. The time you execute the option, you got 2 years, let's say, to then be able to cash the seller out completely. So bring to the deal, say, hey seller, I got my stuff together, I put it down. Or Mr. Seller actually got somebody who want to buy the property. So they're gonna pay you your price, I'm gonna pay you your price, and I'm gonna get a spread on that. But you have a period of time in which you have to execute, because an option means just what it says. You have the option to purchase the property. You have what's called equitable title, rights to that title, right? Nobody else, the seller can't sell it to nobody else during that 2-year or however many year period of time. You got that deal, right? If you don't come through though, on that period of time, what happens is your option consideration is gone. You know what I'm saying? It's theirs. You know what I mean? So that is the risk. That's why I say 1 to 5% of the person. If you can do it for $1, do it for $1. My first deal I ever did in life in real estate was 2003. I put $1 down. And it was a true no money down deal because I had to borrow $1. You know what I'm saying? In real life, we had to do $1 down. It was a 6-unit apartment building in Pueblo, Colorado, where my dad was living. I was visiting my dad for the summertime. I told my dad, I got this course, I was juiced. I said, Pops, watch, I'm about to buy a property. Got all excited, found a deal. I was advertised, no money down, lease option to buy, come check out my property. I went there, we negotiated, but he was like, look, it's no money down, but there has to be something to buy in the car. You can't do it for no value. It has to be value consideration. And we call option consideration. It literally can be $1. And I went there, I met the dude, I shook his hands, I signed the papers, I looked at my wallet. Damn, man, I don't even got $1 right now, man, I'm doing bad. I was in school. I called Pops, I didn't, just let me get $1 real quick, and I got you. You know what I mean? That's literally how we did that deal. Now, I didn't make no money on that deal, but that got me into the world of creative financing, got me into the world of business, and showed me the possibilities of what I can do coming from East Oakland, all the way out here across the country, and what can be structured, all right? Now, here's what's also important, is you want to negotiate a part of, if you can, I don't think this is a deal if you can't do this, but if you can, a portion of that monthly lease fee that you pay to the seller, go towards the purchase price. Whatever you can do. This is kind of similar to your equity buildup in a mortgage. Every time you pay a mortgage, a part of that mortgage is principal, right? So you're building up equity when you pay your mortgage because you're paying down principal. So if you do a lease option, let's say you're doing $5,000 a month. So I think a rule of thumb is try to get 5 to 10% of your payment to go towards the principal. And all they do, they take the money. But we've got a ledger that when time close of escrow, that amount that you've been paying every month gets totaled up, and that goes towards the purchase price. It's like a credit on the statement, on the closing statement. So that's a form of your equity buildup. If you can negotiate that, that's a really well done master lease option. Tough to do, but it can be done. And I have done that before on behalf of clients. All right, so keep that in mind. What's important here to remember as we go through the strategies, the deed don't transfer until you execute the option. all right, you have a form of title though. It's called equitable title. Remember that. You have rights to the title. That's important because in this next strategy, a land contract or a contract for deed, like we call it in California, it's called you know, what it really means is it's an installment sale, right? You know, the buyer is buying the property from the seller in installments, in payments that are broken down, okay? It is very similar to a lease with option to buy in that the deed does not transfer. And when you execute a contract for deed, you are executing a deal where you have, again, equitable title, rights to the title. You don't have the title at close of escrow. The deed does not transfer. Now, you have rights to that title. And I haven't had problems recording a contract for deed. I've done this twice on behalf of clients, right? Where, and even in Santa Clara County, where they wouldn't record an option on a deal I did before, they did record a contract for deed. I sold a church back in the day in like 2011, where we wasn't no financing, so we had to do this kind of deal, and they recorded that. So it's similar to a lease option to buy. It differs in that, okay, installments, there has to be monthly payments towards the property. But where it really differs is what's typical in installment sales is there's lump sums made towards the purchase price during the period of time for the installment. So typically you'll have a monthly payment, and then maybe, the way we did it, to give you an example of what we did in San Jose, is we say, hey, there's monthly payments being made. I think those monthly payments were $3,000 or $4,000. And then what we said, it was a 2-year installment period of time. Every quarter, every 3 months, every quarter, the buyer will put down $50,000 towards the down payment, right? And then they had a loan that they were going to assume, but it was this big like $300,000 down payment that we were working. That was what we were working the installment on, right? So every quarter that went by, they put $50,000 until we got to the end. They put the last $50,000, went to escrow, deed transferred, they assumed their loan, boom, it was done. But for the 2 years that we had that set up, they were making monthly payments and quarterly installments, quarterly down payment installments. That's where that's a little bit different than the lease with option to buy. Same way, same general structure, but a little bit of a nuance. And both these strategies are great because you can control the property before you fully own it with a little bit of risk. Now, when you do a contract for deed, you also got to put something up front. It could be $1 to buy it, but it's got to be something. Again, it's what you negotiate, and you're dealing with the seller. All right, deed don't transfer at close of escrow. Keep that in mind because it's in the next one. Now, this one. Anybody heard about this before? Wraparound mortgage. That's the slang for it. That's the ebonics for it. It's called all-inclusive deed of trust. That's the real estate word. It's all-inclusive deed of trust. What that means is a wraparound mortgage. The mortgage literally wraps around the existing financing, right? In this element of creative financing, the deed transfers at close of escrow. So when we close this deal up front, deed goes from seller to buyer. Here's what we're doing though, all right? In this instance, there's existing financing on the property, right? Let's just give an example. Say it's $1 million property, right? And say there's a $700,000 loan on the property. So, seller's having a problem selling the property. The seller comes in and we work a deal out. $1 million, the seller says, hey, I will carry $900,000 in a form of wrap. I want you to only put 10% down. Remember, commercial real estate, 10% down is a very low down payment. So that is gonna help us get in that property. That's gonna help us increase the rate of return. So we say, okay, that sounds great. Let's do the deal. We'll do it at $1 million. You carry $900,000 in first position. What that means is, at close of escrow, remember, the seller still has a $700,000 loan, right? $700,000. This is that $700,000. At close of escrow, the seller is going to carry back a wraparound mortgage, which is for $900,000. So that $900,000 loan, this is the $700,000, is going to then wrap around. It's going to be all inclusive. That $900,000 is going to wrap around the $700,000 and include that. And the payments made, so at close of escrow, boom, deed goes from seller to buyer. I get the deed. That don't happen in lease options. That don't happen in contracts for deed. But in a wraparound mortgage, now the deed transfers. Now the seller executes that $900,000 mortgage in behalf, or the buyer executes that $900,000 and gives to the seller that mortgage. $900,000. So remember, the seller has a $700,000 mortgage. Now that seller gets a $900,000 mortgage. So they got $200,000 of equity in that mortgage. Buyer's gonna make payments to the seller, right? Payment's gonna take those payments, and they're gonna pay their mortgage, right? They're gonna pay their mortgage. What should happen is the seller gets an amount that's higher than their mortgage, right? So when they pay their mortgage, they're making cash flow, right? And every time when they paying that mortgage off, they also are getting equity because they're owed $900,000. And so they gotta pay off $700,000. Every time they make a payment, that $700,000 gets less. They're making cash flow the whole time. And when you eventually refinance or sell a property and pay them off, they're gonna pay their lender off and they're gonna make their profit. That's called a wraparound mortgage. Now, it's risky because, hey, you as the seller, you gotta make sure they pay you. Because if they don't pay you, you still, that loan is still paying. Remember, bank don't know about this now. And it's legal, and all-inclusive deed of trust is actually language in your real estate exam, especially in the broker, but it's not in the salesperson exam. So this is a mechanism of financing, right? That was big in the 70s because of the high interest rates. You know, if you got could you imagine something? Say this property we're talking about, $1 million property. That's $700,000 loan. Say that loan was 3%, right? Because they got it a year ago. Make sense? Now, if I go and carry financing, that seller can say, hey, I'm gonna make this deal for you. I'm gonna carry $900,000. I'm gonna carry that 5%. The rest of the market's 6 or 7. So you're winning now. You know what I'm saying? You are a winner. That seller's getting 5%, but they're paying 3%. So they're making a spread. You know what I mean? You know, and what would be even better is you can get in, if you qualify, if you can talk to that seller, if you have that money to put down, talk to the seller, and you assume they're 3%.
You think that's gonna be very popular since we became such a historical law?
I know, I'm pushing it, you know what I'm saying? I know I'm pushing it, and I think it is gonna be popular, I think, because look, man, sellers got equity. You mentioned it, you said, hey, money's getting tight, eventually somebody gonna have to sell their car, have to sell their house, or, you know, sell something, and that's probably not gonna go at full market price. And then when they come back and say, well, what am I gonna do in real estate, it might sit. So what do we do? This is something that can be done. And a note here is very similar to, have you ever heard of subject to financing? That's more popular in residential, but it's very, very similar. You basically take over that property subject to the existing financing. The bank don't know about that. So this is not a formal assumption. Subject to is not a formal assumption. Don't go to the bank and their policy. They don't even know what happens. You know, it's legal though. I want to make sure that's clear. It's legal. Banks though, whether it's subject to or wraparound mortgage, typically have what's called due on sale clause, meaning that their money is due upon the sale. You know what I mean? That you need to pay them off when that happens. They typically will not be in your business unless if they get their payments on time. It's when they don't get their payments on time that they might call the loan. Call the loan means we need our money. That is the risk. Each one of these strategies, involve risk. This market involves risk. The reason we do these things like this, and it's part of like me and Matthew's been rocking like this for a while. He runs a financial planning firm. I run an investment firm in real estate. But our philosophies is the same because we're thinking that we want to educate our marketplace. If we bring value to the marketplace so that we can then do deals. Because there is risk involved, because there is money involved, because like we're wanting to serve people's needs in a way that is helpful to what they're doing now and ongoing. That way we can do business with them. So when there's risks or things that you need to be aware of, I would rather for you to know that and understand that, while we're talking about doing business. Because if you don't know that, you don't understand that, it makes doing, like I said, I sold a building last year. The guy said, I don't want no inspections. You sure about that? I just send an email and say, hey, look, I gotta, because this is me covering I'm running the business right here. You should get an inspection. Don't want to get fined. Just acknowledge this email right here because I'm letting you know that you're supposed to get this inspection. I've got to look out for you. You know what I mean? And so that's part of how like we want to roll is to not to sugarcoat it, but to tell you like, hey, we got some alternatives out there. You don't have to just wait on Bank of America, Wells Fargo. There's other ways to do it. Just understand the risk that you're involved. So like wraparound mortgage, I've done that also for clients, and that's been a great way of getting things done. You just need to make sure that you understand the risks associated with it. And that the biggest risk associated with that one is that if the bank calls the loan, then they need to get their money or they get foreclosed, right? The reality to that one is the bank's not going to call their loan if they're getting their payments, right? And in general, in life and in business, real estate, if the payments are going through, we're good. It's when the payments don't go through that there's issues that pop up. Make sense? All right, so now when we come into the world, I kind of dealt with the face, and I'll wrap this up, I promise. Next 5 minutes, 10 minutes. We talked about what the seller can do in terms of their money. We talk about other people's money. We talk about like the seller has equity. Now they can help you out to finance that deal. Now let's talk about, let's say the seller ain't helping you. Seller's like, look, I'm selling this property. I can't help. You know. We're working a deal now with the bank. Well, it's a hard money lender. It's not a bank. It's a foreclosure. We're working on the deal. We have originally asked them to carry financing. They already made the loan. They're like, you know what, we're not carrying financing. We will drop the price, but we're not going to carry it because we just want to be done with this, right? And there's going to be a lot of sellers that are in that position. Say, hey, maybe I don't want to live with this deal no more. I want to be totally done with it. So, if you then don't have all the money to put as a down payment, what do? Well, then what you do is raise capital from other people or institutions for the down payment to help you to get the deal done. Now, this would involve you, well, unless you can raise a lot of money, it would involve you going out and getting financing in your first position, but then for the down payment, putting investors together to close the deal. So, these are some mechanisms in which you can raise money. You can raise money through joint venture partnerships, typically where there's a managing member, you the person putting the deal of the LLC, and then there's limited members of the LLC, investors who are only limited to the money, their liabilities only limited to the money they invest. There's tenant in common and Delaware statutory trust. These are similar to LLC investments, but they're different. They're different in that each investor gets a deeded interest into the deal. If you invest in an LLC, the LLC owns 100% of the deed, and then you own your percentage of the LLC. Tenants in common or Delaware statutory trust is where each investor has a percentage of the actual deed. So the sponsor of the deal owns the 30% of the deed, and each individual investor will have 5, 10%, 20, whatever they own. That's significant because people in the 1031 exchange, when they sell their property, they cannot come into an LLC and they cannot be purely invested into an LLC if it's a group. They have to have what's called a deeded interest into the property. So they have to have a percentage of the deed. And that can be accomplished through like a tenant in common structure or the Delaware statutory trust, right? So that's another way to raise money and put that into a deal. Now, what's popular now is crowdfunding. Those are internet websites where you can go and raise money. However, very, very expensive to set those up, and a lot of regulation you have to deal with if you're doing that, because most investments you can't advertise. If you want to have an advertised offering, you can do that, but it costs a lot of money to get it up. But once you do that, you can put it on all the crowdfunding sites that's out there. There's a lot of them out there that you can go and raise capital from. Now, another thing that you knew, when people invest with you, they can invest in promissory notes. That could be a promissory note that is against the property, against the LLC that owns the property. If they say they don't want debt, or they don't want equity, they just want a fixed return, then they can be in a promissory note position on the property, and they get a fixed return. The difference between that and, like, say, an LLC investment is that LLC, they're going to own a percentage of the LLC, and they're going to get a percentage of whatever the profits or cash flow is, tax benefits. That may go up, that may go down. It may be more, maybe less. The debt instrument is a fixed return. That makes sense? So I'm getting 12% of my money, 15, 20, whatever the rate of interest is, I'm getting that return on my money. versus if I got an LLC interest, now I have maybe 10% of the deal, and whatever the deal profits, I get 10% of it, right? All right, so that's a big difference. But these are just the different structures of how you can raise money and get them, get investors towards your deal. There's also raising capital through the structure. I know Martinique, we've talked about that a few times. Developing a fund is something that we are doing. We are in the process of raising or developing a fund. We're kind of in the legal planning stages of putting that together for a few of the projects that we have. And a fund is nothing more than an LLC, but it's an LLC that's structured in a way to where people invest in that LLC, and then you as the manager, you then go out and select the deals. They're not necessarily saying, hey, I'm investing in this one deal. I'm investing in what's called a blind pool. I'm investing in a pool of money to go out and do these types of deals, right? For us, I mean, you gotta have some deals lined up to make it happen. But essentially in a fund structure, the people are investing in your fund. You as the fund manager take that money and then go out and invest it in the projects. So these are just a couple structures, ways of how you do it. Now, hard money and structured finance. Hard money is typically done by individual, high net worth individual funds. What they will do, they'll lend you 65 to 70% of the deal, and it's typically going to be 10 to 20%, 10 to 12% interest. We might be starting to see 12 to 15% interest. That's what I saw back in the day, and I think we're going to start moving towards that because they're not stupid. Everything else is, Jason said interest rates going up is good for some people. It's definitely good for lenders and people like in the hard money business. They're able to charge more if the banks are able to charge more. That's just how it goes. So now, on top of that, structured finance, I mentioned this a little bit, and I'll go more into detail. Structured finance, and this is typically for the bigger, is where an investment firm will come in and put equity, cash as equity, or it could be even structured debt on top of the senior loan. So like a second position deed of trust, but these are structured differently. They're structured as like equity in the LLC, and it typically will go up to 80, 85, maybe 90% of the total cost of the property, which still would involve you coming in with about 10%, maybe 15% down, but it's not 30 to 35% down. And that's the big thing about commercial real estate. It's a big difference of the down. Residential investment probably do 20, maybe 20 living for 20% down, right? If you're living in the unit, that's a different loan, But in a commercial property, you typically gonna put 30% down, right? So if when you're talking about go out there and buy a $10 million, $20 million property, this is where structured finance comes in and play, because then they come in and put that capital that bridges you between the hard money loan or the regular loan and the cost of the project. And these are usually for properties that need some help, that need some repositioning, they need to get renovated. Hard money lenders, most lenders are not going to give you a loan on a property that has a bunch of vacancy and needs a bunch of work. Hard money lenders will, it's more so based on what is the project going to be after you renovate, right? So that's why a lot of these funds are looking for deals like that, and they'll come in with capital 85 to 90% of the capital stack. Where you got to come in is with that 10%. Now, if you're getting written out, one of the deals I worked on in 2007, when I was really young in the game, what got me exposed to this world, a $24 million apartment building in Houston, Texas. The first position loan was $18 million. It was $24 million purchase price. So $18 million got us most of the way there. Owner came and assumed that loan. But then we had to come up with $7 more dollars to close this deal. So what he went to a structure, he got $5 million, we're at 23. We was there, we just needed $2 million. A deal happened, whereas if we just looked at the high interest, the economy, we can't do it. You know what I mean? Of which most of this real estate business is crap. I'm going to work in the corporate world. I remember in 07 and 08, man, and we was doing deals under there. Everybody was in real estate. We would go to a meeting, and everybody in the meeting was a real estate agent. I remember people in the hood doing loans. I remember being in Brookford sometimes. I was at the storefront, after getting some gas, and I seen one of my partners. Hey man, I'm doing loans now. I'm doing loans, which I was glad to hear that. But I mean, everybody was doing loans. Easy money, right? And changed. I mean, I would say more. I don't know what the numbers is at that point in time, but from my vantage point, going to meetings, going to networking, you know, if you're a real estate agent, broker, or mortgage, especially in mortgage, right? More than 50% of the people left the business. And in fact, they left the business when it was the best time to be in the business. You know what I mean? Wasn't the easiest time. Wasn't the easiest time. You know what I mean? And the loan people that I know that stuck it out made a lot of money because they were some of the only people making it happen. And then on the flip side of that, they got the reputation, and the market came back around. This person, this company, this group, they deal makers. You know what I mean? And now a lot of those people, you know, when they roll up on this second market, when they came out of that, it's hard to play with those people. I know that I used to do, I can't even get a call. I can't even get a call back from these guys. But that's because they got so much business and they've established themselves. So that's what we have the opportunity to do. And now this market has shifted. You know, whether like what Jay was saying, whether we're officially in a recession or not, it's confusing. I thought we was in it because of the whole GDP situation. They haven't said, the powers that be haven't came out and said it's officially a recession. They definitely not gonna say it before the election next week. It's next week, right? Elections?
2 weeks.
2 weeks.
November 8th.
It's coming. They ain't gonna say it before the election. They might say it after the election, or whatever happens. But I mean, I think we're in a recession. And if we're not in one now, we're definitely going to one. And it's not it's not a horrible thing. It's some pain, some temporary pain. Like what Matthews was saying, that's part of what we gotta do, gotta go through. Right? I coach football. Like I tell my kids, we start our practice the first 30 minutes, we're working out. You know, and it don't feel great. I told them on the other side of that pain is success. You know what I mean? And there's pain when you're working out, that okay, you got a sharp pain in your shoulder, okay, maybe stop doing what you're doing. But if your muscles is burning, that's what we want. You know what I mean? We have to go through that if we want to hold up that trophy at the end of it. You know what I mean? We all, as a marketer, we got to go through some tough times. That's why I want to hear from Jason what's really going on, and me to tell y'all, okay, these are some ideas of how we can make some deals happen. Is it going to happen like that every single time? No. But this is just a tool in your toolbox that you can utilize to try to navigate through the waters and close a deal. And at the end of the day, that's what we're here for. We're here to solve problems, close deals, make money, help out the marketplace. So, with that being said, that wraps up my presentation. Does anybody have any questions, thoughts, or comments at this time? And if not, I really, really appreciate y'all. We can have some snacks, and we're gonna make sure before y'all leave, y'all meet somebody.
No, we're gonna just finish, but one thing I kind of 1031. I mean, can you 1031 and do seller financing with the same deal?
That's actually a real good question. Not a stupid question at all. That's at me. All right. Yes is the first answer. 1031 qualified intermediaries really don't like that, right? But it was a significant amount of money in the down payment. And then they rolled that money over to another investment property. But that creates a lot of level of complexity in the 1031 exchange. All right. But I've done it before. I've had a couple people say, nah, you can't do it, don't do it, it's not worth it. You know, because it gets complicated. But what you just said, I mean, that's kind of the goal of tax deferments is carry some paper, you know what I mean? So you ain't paying capital gains on that, and with your gains you get, you then take that and roll it up. There is some complications with that though. I don't exactly know what those are, because when we work the deal, I just kind of, have the accountant talk to the qualified intermediary and say, hey, we're gonna work this out, and we were able to work that out. But that was one, and I've had two ones where it didn't happen because they was like, nah, it's not worth it. You know what I mean? It's just too complicated, too complex. Either they do an exchange or they carry finance. But it can be done. And that is not a stupid question, but that is a real, actually high level question, because a lot of people, if you can do that, that is a great way to go about doing what you're doing. You know what I'm saying? I have one right now where we're doing their carrying and financing, and the title company is trying to make them pay what's called California withholding tax. Which is, I won't even go into that, but that's not capital gains tax. It's a tax they get you, and when you file your taxes, they give back to you. But they hold your money for you, but at close escrow, they take 3 1/3% of the deal. And that's not really, nobody wants to pay 3 1/3% of that, right? So we're trying to work on ways, we're trying to see if we can work around that. The property is owned in the trust, They are carrying financing, so we're gonna see if we can work around that tax right there. A great question. All right, and if there's no other, man, it's been real. I really appreciate y'all. Thank you for your time. And come see us next month. We're gonna be here the fourth Thursday, the fourth Wednesday of the month. Thank you. You too.